Hey, welcome to the show. You found us, Retire with Integrity, brought to you by Integrity Financial Planning with Brian Bowen. He is the president and founder of Integrity Financial Planning. I just shine his shoes. Kidding. I'm Brett Sharp. If you're nearing retirement, I'm sure you're liking this bull market. But you're also probably asking how much longer can it last?
Right.
A piece in MarketWatch warns that future returns are likely to be mediocre. If that's true, Brian, how do we make sure that those mediocre returns don't torpedo our retirement income?
Yeah, that's true. I mean, you look back at the last 10 years and you go, wow, this thing did 10, 12%. And I'm telling clients, let's just try to cut that in half. You know, let's not realistically expect that going forward.
Managing expectations.
Yeah, I don't see it. You know, we were coming out of the 2008, 2009 recession. We haven't had a recession since then. And technically, since they started recording recessions, Federal Reserve, I think 1913, when they started recording recessions, there's been one every 7 years. So we're a little overdue.
Mm-hmm.
And so it's not
That's a scary thought.
I know, it is. But then, you know, there's always the booms and then there's the busts, right? And so we've got a boom right now. Real estate is on fire, as you know, right? And so is the stock market is on fire right now.
I keep waiting for it to go down. It stayed above 23,000 for a long time.
Right. Yeah. So you've got issues, though, with thinking that it's going to be like this forever. Right. I'm just going to get 15% returns or 12% returns every year. And, you know, so you've got to really, and actually there's some time periods. You look at the Dow over 20 some years, there's a lot of spots there where it's 4 or 5%, 20 years. That's going to make and break some people's retirement. So a lot of people are retiring early with not enough money. That's the biggest problem I think I see. They're coming in here with, under, $500,000 thinking, oh, I got plenty of money. They don't have any pensions. Their Social Security's not big. It's hard for me to tell them, but I don't think you're going to have enough. Right. And so what do you do about that? Well, you either work longer, take more risk in the market. What other thing can you do? There's tax planning things you can do, but you can't really. And if the folks live well below their means, then it can happen, right? I mean, that's possible if they are living very, very low. But a lot of folks, when they retire, they want to do what? Go on vacation.
Fish.
Yeah.
Just go jack around.
Right, yeah.
Buy stuff.
Well, that's what you want to
buy
do.
a boat.
Not right.
But once upon a time, I thought once upon a time, $500,000 sounded like a ton of money.
It did.
It doesn't go as far.
It's not right. No, they're selling boats. You know, you can go to Smith Mountain Lake. You'll see boats running around there for $150,000, $175,000.
Yeah, a bass boat's $70,000, $80,000, $100,000. Yeah.
So those wake surf boats that are flying around there that's a house.
Right.
My first house was $90,000.
Right.
It's a nice 3-bedroom, 2-bath house.
Yeah.
You know, so it's.
$500,000 sounds like a lot, but if you're going to live to be 85 and you're going to stretch that amount of money,
it's hard. No, cool. The math is really a struggle for folks because they go, well, if I took 4%, that's 20,000. I get Social Security between my wife and myself was, that's another 30,000. So I got $50,000. I'm good. Well, you got to pay taxes on that.
Mm-hmm.
And that's assuming that you can take 4%. What if the market declines for 7 years? Your account values will go down. There's something called sequence of returns, and this article isn't really talking about that. But we talk about sequence returns when you are, let's say you retired in 2 years and everything was still cooking with gas like it is now. And then all of a sudden the market just tanks and you are taking out income and there's a -10, a -20, another -15, 3 years in a row. And you're taking income out, right? You retired. Mm-hmm. Remember, you're fishing every day.
Yeah, you've done it now. Right. Now you've made the move. Yeah.
Yeah. You're not going back.
Stuck. Yeah.
So you're taking an income when it's dropping in value. It's called sequence returns. They're actually teaching it in financial planning colleges all over the country now because it's a real problem. It's like, okay, the math, you start looking at it and you go, wow, you never recover from it. And it's not a fear-mongering thing. We can show you 18 different ways to show you it. You can have a really good rate of return, still get 8% rate of return, but you ran out of money. Mm-hmm. Who doesn't want 8-9% rate of return, right? But if the market went up the same year, same time, right, you retired, and you still got that 8% over that 20 years, you were so successful.
Yeah.
But it's just all timing. Do you know if it's going to be a bull market or bear market and you retire?
Well, no, I mean, nobody knows.
Right.
Yeah.
And that's the point, I think, of this article is like, well, are we coming up on that? And all these people are seeing their account balances go up. I'm finally there. I can finally retire. That's what happened in 2008. A lot of people had to go back to work.
I hate to feel pessimistic, but I keep waiting for the stock market to just crash. I really do. I know that sounds terrible, but I keep waiting for it to go down.
Yeah, don't wish it. Okay.
Yeah, thanks.